Most people think a bank is a vault. That is the first mistake. A vault stores your property. A bank transforms your property into its raw material. It takes what you call cash, turns it into its own balance sheet fuel, and gives you back something that feels identical to ownership only as long as the machine stays calm. I want to begin where most people never begin. With the worst moment, not the comfortable one. Picture a man in rural America in the early 1930s. He has worked all year. His crop has been sold. The money is in the local bank. He drives into town needing a small amount for supplies and seed. He does not find a shortage of money in his life. He finds a locked door. He can see the building. He can see the vault. He can point to the institution holding his family's winter survival. But that does not matter. The glass is between him and the money, and the law is now between him and the claim. That is the point where financial theory stops being theory. If you want to understand banking risk, do not start with interest rates. Do not start with FDIC brochures. Do not start with the polished language that says the system is resilient, liquid, well-capitalized, and closely supervised. Start with a locked door. That door is the only truth that matters in a panic. I have spent my life studying businesses, incentives, structures, and the strange habit people have of mistaking smooth function for permanent safety. They see a bridge hold for 20 years and conclude it cannot fall. They see a market rise for a decade and conclude it cannot break. They see a bank honor withdrawals every Friday of their adult lives and conclude the money is sitting there waiting for them by name. It is not. And once you understand that sentence, you stop asking the childish question, is my bank safe? You start asking the adult question, under what conditions does my access disappear? That is a very different question. It is also the only one worth asking. The first mechanism I want to name is the access illusion. The access illusion is what happens when repeated convenience impersonates legal ownership. You use a debit card, the payment clears. You move money from checking to savings, it arrives. You wire funds for a home project. The contractor gets paid. Every ordinary success trains your mind to believe the system is a storage system. It is not a storage system. It is a confidence system. The number on your screen is a promise made by a counterparty. It is not a pile of your cash sitting motionless under fluorescent lights waiting for your command. The day the promise weakens, the difference between those two realities stops being philosophical and starts being operational. That distinction is everything. If I hand you a coat check ticket, you feel like you still own the coat. In one sense, you do. In another sense, your access now depends on a ticket, a clerk, an orderly line, and a building that remains open. Banking works the same way, only with more jargon and more screens. Most people never examine the legal structure because the machine is designed to make examination feel unnecessary. That is not an accident. A comfortable depositor is useful. A curious depositor is dangerous. The second mechanism is the duration mismatch. That sounds academic. It is not. It is the crack in the engine block. A bank takes short-term promises and funds long-term bets. That is the whole trick. You can ask for your money today. The bank has committed most of that money to assets that mature far later: mortgages, commercial loans, securities, portfolios, credit exposures, things that do not turn back into cash just because you happen to want cash on a Wednesday morning. That mismatch is not a side effect. It is the business model. In calm periods, nobody notices. Deposits come in, withdrawals go out, the flow roughly balances. Management looks competent, customers feel intelligent, regulators look serious, everybody wins the public relations game. Then confidence breaks, and when confidence breaks, mathematics takes over. A bank does not fail because depositors suddenly become irrational. A bank fails because enough people become rational at the same time. That is the part polite society never likes to say aloud. If one customer wants cash, the system smiles. If 10,000 customers want cash, the system reveals what it is. History is full of adults learning that lesson too late. In the early 1930s, thousands of American banks did not collapse because every one of them had a cartoon villain in the back office. They collapsed because the structure itself was brittle. A fraction was kept. The rest was committed. The depositors had daily claims. The assets were slow and sticky. Once withdrawals accelerated, the institutions ran out of oxygen. People remember the stock market crash because headlines are always attracted to noise. I do not blame them. Noise photographs well, but the deeper destruction came after the headlines. When ordinary savers discovered that what they believed to be cash was really a place in line, and line position is a terrible thing to discover in a panic. The third mechanism is the confidence wall. A bank does not sit on concrete. It sits on belief. As long as depositors believe tomorrow will resemble today, the structure holds. The moment enough people begin acting on doubt, the wall starts to crack. And here is the cruel part. Even sound institutions can be damaged by a loss of confidence. Because confidence determines the speed of withdrawals, and speed determines whether assets must be sold at bad prices. A weak bank dies from bad assets. A strong bank can die from bad timing. That should bother you. It should bother you because most people are still trained to think in moral categories. Good bank, bad bank, smart manager, dumb manager, greedy lender, careful lender. Those things matter. They are not enough. Structure outruns morality in a crisis. If you own a wonderful business with too much short funding, it can break. If you run a careful bank and depositors sprint for the exits, it can break. If you hold assets that are money good over 10 years but need cash in 10 hours, you can still break. That is why I tell people that liquidity is not a feeling, it is not a slogan, it is a time test. How much can be turned into spendable money? At what price? Under what conditions? By whom? And how fast? That is the whole game. Everything else is a brochure. Now let me tell you where the average person gets seduced back to sleep. Insurance, the fourth mechanism, is the insurance veneer. Deposit insurance is useful, it is real. It can stop a localized panic from becoming a national stampede. I am not dismissing it. I am telling you what it does not do. It does not repeal structure. It does not eliminate timing risk. It does not mean every dollar in the system is sitting in an equal state of certainty. It does not convert a fragile machine into an indestructible one. It manages confidence that matters. But confidence management is not the same thing as immunity. People hear a coverage limit and stop thinking. They behave as if the existence of an airbag means the laws of motion have been repealed. That is not how safety works. Safety is layered. Safety is ugly. Safety always looks a little inefficient before the crisis and a little brilliant during it. The human appetite is to optimize everything, squeeze every idle dollar, keep everything productive, minimize friction, avoid the embarrassment of holding too much cash, avoid the appearance of paranoia, avoid the inconvenience of backups. That instinct works beautifully until the day friction becomes freedom. I have watched this pattern in every form of finance. People hate optionality when nothing is wrong. They worship it when something is. That is why every banking discussion worth having must eventually turn to one hard question. Where do you place liquid reserves if you do not want all of your liquid life to depend on one promise, one institution, one jurisdiction, one switch, one login, one weekend decision by people you will never meet? Now we are finally asking the right question. The fifth mechanism is the bail. In ladder. Again, the language sounds technical because technical language is the preferred hiding place of ugly truths. A bailout is public rescue. Everyone sees it. Everyone screams about it. It is politically expensive, a bail. In is quieter. Losses get pushed inward. Claims get rearranged. Certain creditors absorb pain. Depositors learn that convenience was not the same thing as seniority. The public story becomes stabilization. The private experience becomes confiscation by structure. You do not have to be a conspiracy theorist to understand this. You only have to understand incentives. Governments do not enjoy writing giant visible checks to rescue banks. Regulators prefer systems in which the damage can be distributed through the balance sheet itself. That preference is not hidden, it is documented. So when people say, "That could never happen here," I do not argue emotionally. I ask what legal mechanism stops it. Usually there is silence. Silence is useful. Silence tells you a story has been believed without being examined. Now let us get practical, because there is a mistake on the other side too. Once people discover bank fragility, they often swing into theatrical solutions. All cash under the mattress, all gold in a closet, all money offshore without understanding reporting rules, all assets in one so-called safe alternative. That is not prudence. That is panic wearing the costume of sophistication. There is no perfect refuge. There are only trade-offs. And adults who understand trade survive systems better than adults who chase purity. Physical cash gives you immediate control. That matters if the grid is down, if branches are closed, if transfers are delayed, if cards stop working. Paper currency can do something digital entries cannot do. It settles instantly in the real world. But paper cash has enemies: theft, fire, forgetfulness, erosion through inflation, and perhaps most dangerously, the illusion that because it is physically near you, it is strategically enough. It is not enough. It is one layer. Treasury obligations sit in a different category. They are not a local bank promise. They are a sovereign promise that matters too. If your concern is the failure of a private intermediary, direct government obligations change the nature of the counterparty. They do not remove all risk. They alter the risk. That is what intelligent people do. They do not fantasize about zero risk. They select their preferred risk. Precious metals occupy a different role again. They are not claims on a bank. They are not promises printed on a monthly statement. They are inert stores of value outside the digital maze, but they come with their own headaches: storage, security, spread costs, volatility, political risk, the historical fact that governments under pressure have, at times, shown an impressive appetite for redefining what private ownership may continue to look like. Foreign exposure introduces another kind of optionality, another jurisdiction, another banking culture, another currency regime. That can be useful. It can also be complex. Complexity is not evil. Unexamined complexity is evil. Real assets, land, productive property, useful things in the physical world have one great advantage. They do not vanish because an app stops working. They also have one great weakness. You cannot buy groceries with the field. You cannot pay an emergency surgeon with the sentimental certainty that a storage shed retains long-term value. Which is why I come back to a rule that has protected me better than cleverness ever did. Never ask one asset to do the jobs of 5 assets. Cash is for immediacy. Short sovereign paper is for near-term defense. Equities are for long-term compounding. Hard assets are for inflation and regime distrust. Human skill is for earning power. Relationships are for information and rescue. If you ask one bucket to play all 6 roles, you are not simplifying. You are gambling. The people who got destroyed in old banking failures often did not lack money. They lacked configuration. They had all their trust stacked in one place. That is a design error. I want to name a 6th mechanism because it matters more than almost anything in a crisis. The optionality rule. Optionality is the ability to choose under stress. That sounds simple. It is rare. When a bank holiday is declared, optionality is gone. When wires are delayed and payroll is due, optionality is gone. When you need surgery and your brokerage is in operational limbo, optionality is gone. When capital controls appear, optionality is gone. When your entire liquid life depends on a single institutional pipe, you are not rich. You are concentrated. The public often mistakes account size for strength. I do not. I ask one question. How many bad mornings can this structure survive before the owner is forced into a terrible choice? That question tells me more about safety than any glossy net worth number ever will. A man with a smaller balance spread across resilient functions may be much safer than a man with a larger balance trapped in one elegant but brittle setup. Safety is not glamour. Safety is a series of dull, almost embarrassing redundancies assembled by someone who prefers surviving to impressing. Now, there is another trap in this conversation, and it is a very modern one. People think the next bank failure will look exactly like the old ones: a line outside a branch, locked doors, paper signs. Angry depositors pounding the glass, it might, but modern crises often begin invisibly. A failed raise, a securities portfolio marked down too hard, a social media run. A liquidity problem disguised as a confidence rumor, and then a confidence rumor transformed into a real liquidity problem in 48 hours. The choreography changes, the law of fragility does not. Silicon Valley taught that lesson again. Fast money can leave faster than old money. Concentrated deposit bases can move like lightning. Bond losses that look manageable in spreadsheets can become fatal under pressure. Emergency facilities can stop the fire from spreading without proving the building was never flammable. That is the nuance most people miss. A rescue does not mean the structure was fine. A rescue often proves the structure was not. I have no interest in scaring people for sport. Fear is not a strategy. Drama is not intelligence. What interests me is clarity. And clarity says this: a bank is not a vault. A deposit is not custody in the common sense. Way most people imagine, insurance is not omnipotence. Access is not ownership. Liquidity is not permanent, and confidence is not self-renewing. Once you understand those 5 lines, your behavior changes, not radically, not theatrically. Rationally, you stop keeping every liquid reserve in one institution because the app is convenient. You stop confusing a high balance with a high margin of safety. You stop laughing at redundancy. You build a personal liquidity stack. That stack does not need to be exotic. It needs to be deliberate. Layer 1 is immediate living liquidity, enough spendable money to handle the ugly, boring emergencies that do not wait for a regulator's timetable. A broken furnace, a family flight, a medicine run, a system outage over a long weekend. If you cannot live through a temporary freeze without begging, your setup is too tight. Layer 2 is short-term institutional diversification. More than one bank if balances and life complexity justify it. More than one access rail, more than one card network, more than one path to movement. You do not do this because you expect apocalypse every quarter. You do it because single points of failure are for amateurs. Layer 3 is reserved capital outside the ordinary deposit illusion. This is where direct sovereign exposure, carefully held short-term government paper, or other explicitly defensive instruments matter. Not for excitement, for resilience. Layer 4 is long-duration compounding capital, the great businesses, productive assets, the engines that outrun inflation and reward patience. This layer is not for next month, it is for the next decade. Layer 5 is crisis optionality, the small reserve of weird, seeming preparedness that looks excessive until the day it looks sane. Enough physical liquidity, enough documentation, enough records, enough operational simplicity that your spouse, your child, or your executor can understand the system when you are not there to narrate it. Most people never build this because they want elegance. I prefer survivability. Let me speak plainly about the emotional mistake too. Many savers are not truly attached to the bank. They are attached to the feeling of normality the bank gives them. A screen balance gives emotional order. A tidy app gives emotional order. Automatic deposits, clean categories, predictable transfers. It feels civilized. Preparedness often feels uncivilized. A little cash reserve feels old-fashioned. A second institution feels fussy. A direct account with the Treasury feels clunky. Hard assets feel inelegant. Documentation habits feel obsessive. That is exactly why most people never do them. They want the look of modern ease more than the substance of structural control. Then the crisis arrives and they learn the oldest lesson in finance. Convenience is usually rented. Control is usually built. There is also a class lesson embedded in all this, and it is not polite, but it is true. The informed get options first. The uninformed get instructions last. In every major banking strain, the people who see the structure clearly act earlier, diversify earlier, simplify earlier, and therefore suffer less. They are not always richer because of brilliance. Sometimes they are simply richer because they understood the plumbing before the leak reached their room. I do not say that to flatter the wealthy. I say it to warn the comfortable. Comfort is the most dangerous stage. Panic is loud. Poverty is obvious. Comfort is quiet. Comfort lets you believe tomorrow will be administratively similar to today. It lets you postpone ugly questions. It lets you assume that because the machine has treated you gently so far, the machine is fundamentally gentle. It is not gentle, it is efficient. And efficiency under pressure can become ruthless overnight. Now, I want to return to Harold in Nebraska because stories matter when structure becomes abstract. He did not lose money because he was foolish. He lost money because he misidentified the nature of the promise. He thought deposit meant possession. He thought a building meant stability. He thought years of normal access meant permanent access. He thought trust was an asset. Trust is not an asset. Trust is a mood. And moods can reverse faster than ledgers can adapt. I do not want you to hear this as a call to exit civilization, bury coins in a field, and live inside a bunker of your own suspicions. That is childish in its own way. I want you to hear it as a call to graduate from the fairy tale. Banking is not evil. Banking is not magical. Banking is a leveraged maturity transformation machine surrounded by law, confidence, and public messaging. That machine can be useful. That machine can also break. If you understand what it is, you can use it without worshiping it. That is maturity. And maturity is worth more than reassurance. So here is the operating system I would leave you with if I wanted to protect your thinking, not just your balance. First, never store all short-term survival money behind one institutional door. Second, separate liquidity from yield. The dollar that must save you this month has a different job from the dollar meant to compound over 10 years. Third, prefer explicit trade-offs over hidden ones. Hidden risk is what ruins people. Fourth, treat convenience as a service, not as proof of safety. Fifth, build for delays, not just for losses. Many people can survive a paper loss. They cannot survive a timing freeze. Sixth, document your system so that a second brain can operate it. Death and confusion are as real as insolvency. Seventh, never let embarrassment stop you from owning a little redundancy. Embarrassment is cheap in peacetime and expensive in crisis. This is why I say the real question is not where to put cash when banks fail. The real question is what kind of failure you are defending against. A short localized banking interruption is one thing, a broad deflationary bust is another, an inflationary regime with weak currency is another, a sovereign confidence event is another, a payment rail disruption is another. The answer changes because the threat changes. There is no universal hiding place. There is only thoughtful distribution. That is the idea adults can live with, not certainty distribution. If the next serious banking rupture arrives, and history suggests one eventually will, I do not want you standing in line at a locked branch wondering how a lifetime of prudence turned into a pleading session with a glass door. I want you to have already done the quiet, dull, almost invisible work of building options. Not because you predicted the exact day, because you respected the structure. That is all preparedness really is. Respecting structure before structure disrespects you. In markets, in business, in banks, the pattern repeats. People borrow confidence from the recent past until reality demands settlement. Then the bill arrives. Sometimes the bill is a crash. Sometimes it is inflation. Sometimes it is a frozen transfer. Sometimes it is a haircut on a claim you thought was cash. Sometimes it is just a delay at exactly the wrong moment. But the underlying mistake is the same. They trusted a machine they had never bothered to understand. Do not make that mistake. Learn what the machine is. Use it for what it does. Well, refuse to ask it to be what it is not. A bank is good at transactional convenience. It is not a moral guardian. It is not a sacred vault. It is not a promise beyond structure. It is a counterparty, and counterparties can fail. Once that sentence becomes part of your operating system, your behavior gets calmer, not crazier. You stop needing panic because you stop requiring illusion, and that is a much better way to live around money, because the truth, however uncomfortable, is always lighter to carry than a fantasy that breaks under load.